Welcome in to EP Wealth's Long-Term Thinking Weekly Insights. I'm Rob Black. Joining me today, Adam Phillips, Managing Director of Investments at EP Wealth. Quick look at the markets, and this has been a very whipsaw or seesaw kind of market, in my opinion. I think whipsaw is the right way of using that term. The S&P 500, year to date, down 3.6%. The Dow Jones Industrial Average down 1.3%. Then we get into a little bit more damage where the S&P 400 is down 5.3%. That's the mid-cap stocks of the United States. And the Russell 2000, the small cap stocks are down 5.7%. Of note, I don't usually include this one, but I did. The MSCI, it's the Morgan Stanley Country Index of emerging markets, are up 6.1%. What's that telling us, Adam? Why are emerging markets, why are markets outside the United States having a better year than the United States markets?
Sure. Well, there's actually a few reasons. Number one, let's just acknowledge that the U.S. markets have been outperforming for years.
That's right.
And I think last year we probably hit peak U.S. exceptionalism where people started wondering, why do I even own international markets to begin with? Why does diversification still make sense? It's this idea of diversification. Why invest in anything outside of Mag 7? Why invest in overseas when obviously these areas have been lagging for so long? And so this year it's funny, these are emerging markets. You would think it's one of the areas that's not going to perform too well during this Trump 2.0 as he hits at some of these areas like China. With respect to trade policy. And in fact, we've seen the opposite. China is performing extremely well. And developed markets outside the U.S., so you think Europe, they're performing extremely well also. So both, if you just let's look broad, international equities are outperforming the U.S. this year. And so it speaks to diversification is working again, thankfully, because I think a lot of people were losing the faith. Europe is outperforming. I think for a few reasons. One is that their central banks are actually cutting rates and providing more accommodative monetary policy right now, while ours is kind of on hold, something I'm sure we'll talk about later. And the fact that Germany and just the broader European Union, they're actually going to open up their wallets here, something they don't do too often. They're going to spend up to $1 trillion on defense and infrastructure spending. It's something that they've shied away from in recent years, and so they voted last week in Parliament to actually approve some spending, and it's going to be meaningful. And so that's going to it could drive their economy, certainly provide some support amid this trade uncertainty, and is definitely helping those areas of their market.
So I wrote down some quick notes, and kind of naive I am. Earnings, tariffs, correction, oversold. Those are the buzzwords that I'm hearing a lot on CNBC and Bloomberg in the financial media. But the one that I didn't break down was the Fed meeting from last week. And we came into 2025 thinking the Fed was going to cut interest rates a few times. That hasn't happened. But yet the Fed did kind of come to the market's defense last week. Tell me a little bit about what you heard from Fed Chairman Jerome Powell last week.
Sure. Well, the FOMC, the Federal Open Market Committee, met on Tuesday and Wednesday, and they came out of their meeting on Wednesday. No rate decision, so no rate cut. No one expected one. But I think everyone was just really waiting to see what the new summary of economic projections that they provide on a quarterly basis were going to say, and obviously what Jay Powell was going to say in his post FOMC press conference, where he provides his prepared remarks, and then he takes questions from the audience of reporters. I guess a couple of takeaways here. They don't have a clue, as far as what the next few months hold. And it was refreshing. What I don't want to hear is Jay Powell or anyone from the central bank really just speculating about what the future holds when things are as uncertain as they are. In the press conference, Jay Powell actually used the word uncertainty 16 times.
Okay.
So it tells you that they're on hold here. They're going to wait and see how things play out, but they are mindful of the risks in either direction. They actually, in their summary of economic projections, they took down their growth forecast for how much the U.S. economy is expected to grow this year. They brought it down from 2.1% to 1.7%, largely because of some of the impact we're seeing to growth right now amid this uncertainty. They also brought up their inflation forecast a little bit, so from 2.5% of where they expect core inflation to end the year to 2.8%. So moving away ever so slightly from that 2% target. And so it tells you that they're going to remain on pause here. They don't want to cut rates too aggressively because they know that inflation is still an issue. They want to make sure that they don't reignite inflation. They also don't want to raise rates, and no one wants that either, in response to potential inflationary pressures because they are seeing some weaker growth. So it's really this balancing act, and I think that Jay Powell, did a very good job, and that's why markets responded quite favorably. I'll just highlight the fact that it was, a few months ago, we saw that the markets responded very well to expectations of Fed cuts this year. Once they
Mhm.
started cutting last year and they said, okay, the Fed's likely to keep going in 2025, the market responded favorably to that. This time around, if and when the Fed cuts, the expectations that it's not going to be because of disinflation, because inflationary pressures are coming down. It's going to be because economic growth is slowing down. And so you just think about, okay, we we all want lower rates, but I think what's important is what drives them, and because that is ultimately what impacts equities and the stock market. If the Fed is responding because growth is slowing down, probably not as bullish or positive of a setup for stock prices versus the original expectation of lower inflationary pressure.
Okay. I brought up some other buzzwords. Let's get to a couple of them because they're all over financial media right now. Oversold, correction, bounce. When I say those three words, what comes to your mind with the stock market?
Yeah, well, look, we got that 10% correction,
Okay.
and it happened in a very short amount of time. It seemed pretty abrupt, this sell-off that we saw over the last several weeks, and we, at least so far, we've kind of bottomed out and we've started to rise. I believe the S&P 500 has rebounded about 4% from the lows about a week and a half ago. And so I think that's to be expected. When it seems like everyone is running for the hills and there's a lot of short-term pessimism, you should expect some kind of a bounce here. And yeah, one could argue that based on a number of measures, the market was short-term oversold, meaning that if everyone is on one side of a trade, then it doesn't take too much to send buyers back in. And so you see a couple of positive headlines, then you might see a little bit of a bounce. The question is whether that's sustainable. At least here, so we've talked about the Fed last week. That provided a nice little bounce. More recently, just this morning, where the market's responding to news that maybe President Trump is going to go a little bit softer on the tariff announcements coming out on retaliatory tariffs on April 2nd. We'll see, but the market is responding, and again, the question is whether this is sustainable. I think one thing that we can probably all agree on is that we're going to be living in this environment where there's going to be a lot of there's got to be a lot of headlines that had come out of this administration that lead to some stock market volatility in one direction or another. And so you just kind of need to be prepared for it this time around. That's kind of the administration's MO. And so along with the positive developments this morning from President Trump, we also saw shortly after that news that they would impose 25% tariffs on any country that imports energy or oil from Venezuela. So it's like these things are going to keep on coming. And so I think that's one reason why, yeah, we're certainly happy to see a little bit of a bounce. We're going to need to see a little bit more to believe that this is sustainable. We're going to get back to those previous record levels and move beyond that. And so obviously that will be driven by policy updates, i.e., tax, trade, and then earnings. And so we don't start earnings for another few weeks here. And so I think those are the things that we're really going to be watching here as the days and weeks go on.
How concerned are you about the U.S. deficit? I know it's something that when I was like 7 or 8 years old, I went to New York City and I saw the national debt clock, and it freaked me out as a young man. It's still getting bigger. It seems to be increasing faster. As a financial person in the industry, and you talk with your peers, how are you feeling about the U.S. debt, and where do we go from here, and what maybe some of the ramifications might be?
boy, how much time do we have?
Not enough.
Uh, I don't think anyone feels good about it.
Okay.
I think the question is, do we believe that it poses an imminent threat to our system, to our economy? And the answer is no.
Okay.
Um, we still are the reserve currency. We're the strongest economy in the world, and so arguably we've gotten very used to um, other economies and countries buying our debt, and that's helped to really drive a lot of our consumption, right? That was deficit driven, and so I think at some point you need to understand that the deficit driven growth that we've experienced over the last several years and decades, that needs to we need to find growth elsewhere going forward, because if you have these ongoing deficits, you need to make sure that as you're issuing debt to fund these deficits, you need to make sure there are buyers on the other side. And what we've seen more recently is that many countries are less willing to buy our debt. This really started a few years ago with the sanctions on Russia and the way in which we, in some ways, weaponize our dollar, weaponize the other countries' reliance on the U.S. And so what we saw shortly following that is that many countries, China being one of them, started looking for other areas to reallocate their reserves. And so we're seeing a lot of their money now going towards gold. That's driving up the price of gold. And so I say all this because it means that the way in which we've always operated is no longer sustainable. That's why Scott Bessent at the Treasury is hyper focused on the situation, and one of his goals is to get the deficit down to 3%. I think it's very ambitious,
Mhm.
and if you look at the numbers, you can't make meaningful progress, at least over the very near term, unless you make pretty meaningful changes to things like entitlement programs, and that's not an area that anyone wants to touch. And so I don't think that that's on the table, even though we might see headlines come across every now and then. I think what's more, what may be more likely, it's certainly not something we want to see, but is cuts at different agencies like Social Security Administration might lower the quality of service, or disrupt someone getting their benefits because of certain cutbacks there. But I think that ultimately it's not a problem that we're going to need to answer for today. We're not going to run into a debt crisis, but it's something that if I'm happy that Scott Bessent's there, because I think he's focused on the right things. As ambitious as some of his plans are, I think that having someone at least acknowledge the problem means that they're going to start setting things on the right track going forward.
We're about a quarter of the way through the year. I want to say thank you very much, Adam Phillips, Managing Director of Investments at EP Wealth. I'm Rob Black for the Informed Investment Market Update. Good day.